Hi, I'm Christine Short, Associate Director with S&P Capital IQ Global Markets Intelligence. In this week's Lookout Report, we take a look at how the fourth quarter earnings season is shaping up. Despite what the markets have been telling us these past couple of weeks, earnings season has actually been very strong. As the third peak week of the fourth quarter 2013 earnings season comes to a close, growth stands at 7.5%, the highest growth rate for the S&P 500 since fourth quarter of 2012. The above-average number of beats has helped to boost results. Thus far, 68% of companies have beaten their earnings estimates, and 64% of companies have beaten their revenue estimates, compared with historical averages of 65% and 61% respectively. Earnings per share currently stands at $28.32, an all-time record for the S&P 500 and the seventh consecutive quarterly record. One metric, however, that seems to have taken a turn for the worst is revenue growth. After hitting a peak of 3.6% on January 27th, revenue growth now stands nearly a percentage point lower at 2.7%. This is a result of recent top-line misses, specifically from big energy companies such as ConocoPhillips, Chevron, and Murphy Oil Corporation, all of which reported last Thursday. The energy sector is the worst performing sector this season when it comes to exceeding revenue estimates, with only 57% of energy companies having missed their forecasts, followed by the consumer staples and materials sectors. Expectations for 2014 are still strong, but quarterly figures have begun to fall. The best and worst performing sectors for earnings growth are the same ones that we saw in previous weeks. Telecommunications services is still the biggest winner, with 85% growth, followed by financials with 16%. On the downside, energy is expecting the lowest growth of all 10 sectors at -7%, with utilities following closely behind with -5.5%. One sector in particular that has been on the decline is consumer discretionary. Although it is still expecting respectable growth of 7% this season, the retailers are taking a particularly hard hit from the disappointing holiday season and bad weather. The negative to positive ratio for first quarter of 2014 is showing signs of improvement from recent quarters. Already, 73 companies have provided earnings per share guidance for first quarter 2014. Of these, 49 are negative, 23 are positive, and only one is in line with estimates, producing a negative to positive ratio of 2.1. This ratio is better than the historical average of 2.4 and is a vast improvement from last quarter. A majority of positive guidance is being issued by IT companies. Peak earnings season continues next week, with 55 companies scheduled to report. I'm Christine Short, and thank you for tuning in to this week's edition of the Lookout Report.